The upcoming presidential election has many people asking the question, what happens if the other candidate wins? Stay tuned to learn more. Welcome everyone to Filbrandt & Company's fourth quarter market update. I'm your host, Kristina Gross. Today's topic is the upcoming presidential election and what the impact of the results will be. Along with the political effects, there are economic ramifications. Specifically, what will happen to the markets and the investments of university professionals that are in those financial markets. With me today are Filbrandt & Company's portfolio managers, Bob Parham and Steve Hoffman. Steve, let me start with you. In our October market update report that was released last week, you pointed out that the traditional views of Republicans as pro-business and Democrats as more socially conscious suggest that the markets would do better under a Republican president. But the exact opposite is true. Why is that?
Well, Kristina, since 1929, the stock market has averaged 11% under Democratic presidents compared to just 2% for Republicans, which sounds great if you're a Democrat, but a couple of outliers had a big impact on those numbers. First, Hoover was in office during the crash of 1929, and then you had Bush in office during the dot-com bubble. And to be fair, it should be noted that the market has performed much better under Republican Congresses than Democratic. In the end, due to the small sample size, there really is no conclusive study that states one party is better for the markets than the other.
Bob, another factor is that the traditional fiscal views of the parties have become blurred.
That's correct. We've become a much more populistic country now, and as a result, it's influencing our politics and especially the fiscal policy ramifications. This is being caused by income distribution in our country as well as elsewhere. Income distribution has become very biased. The last 20, 30 years have featured all the income gains going to the wealthiest individuals in this country. So we have a problem with this, and it's affecting the approach to fiscal policy going forward.
Steve, I have heard that there is one particular year of any presidential term that produces the strongest average stock market returns, and by the same token, one particular year in a presidential term that is generally poor for the markets.
You're right. The third year of the presidential cycle has been especially strong, averaging about 16% per year. This is almost double return if you looked at all the years together. The theory behind this is that the president will implement tough fiscal measures early on in his term and then add stimulus later on, hoping to help with re-election. Now, the worst part of the presidential cycle is the fourth year when there's no incumbent running, just like we've had this year. Historically, the market has lost 3% during time periods like this. We may break that cycle this year, though, as we have strong positive returns heading into the fourth quarter.
While the markets may not care which name is on the Oval Office door, fiscal policy is something that could have a significant bearing on the direction of the financial markets.
Kristina, I agree with that. I think fiscal policy is going to be key to the success of this economy for the next 3 or 4 years. We have been relying on monetary policy to carry us through. We've been growing very slowly. The Federal Reserve has observed that we need the stimulus of very loose monetary policy, but we've run down that course for so long now, it's having no impact. As a result, what I think we have to do is forge together some very effective fiscal policies. We need spending as far as on structures in this country. Infrastructures are corroding dramatically, and we need to begin to improve that. We need to revamp our tax code, both commercial as well as individual tax codes. These are critical measures. And then finally, we need to deal with all the money. There's almost $3 trillion of it. All the money that's overseas and can't get back home without being outrageously taxed. So there's several things that we can do. There's some solutions to our problems, but I'm not sure that politics will allow us to go forward.
Steve, how are corporate earnings another key indicator?
Well, a recession is defined by 2 consecutive quarters of declining GDP. Looking at earnings, it looks like we're going to have our sixth quarter of consecutive declines. So in essence, we've had an earnings recession. The good news is that analysts expect this to turn around. They're looking for 8% growth for the fourth quarter of this year, and hopefully we'll get 14% growth by the end of next year. We think that is why the market's been trending upward, and that's also why we're more focused on the upcoming earnings reports and how they compare with analyst estimates than we are with the election. In the long run, we know that stock prices will follow earnings.
So Bob, what is Filbrandt and Company's overall outlook for the fourth quarter of 2016?
It's good. We think that earnings are going to really turn in the fourth quarter. That's important. We've been in, as Steve said, we've already experienced 6 straight quarters of down earnings. If we turn in the fourth quarter, which I expect we will do, it'll be a good leading indicator for next year, possibly a good year again next year, if politics don't disrupt that. So I'm optimistic at this point.
Bob, do you have any final thoughts?
Well, yeah, I do. I don't want people to walk away from this recording with the notion that we're placing heavy emphasis on the outcome of the election. We aren't. I've been watching elections and financial markets for 50 years, and I swear I haven't been led correctly in interpreting presidential elections, not one time. So there's very little value in the feedback that we get from political events as far as the economy and as far as the stock market and bond market go. So don't put too much emphasis on this. I think what Steve discussed was earnings and pointing out that earnings are the key driver of stock prices. So our listeners should keep an eye out on the earnings progress of U.S. corporations, and if that stays on track, I think we're going to have a good stock market.
Bob and Steve, thank you again for your insights. As a reminder, Filbrandt and Company is an independent financial services firm that serves the comprehensive financial planning and unique portfolio management needs of university faculty. Today, Filbrandt and Company has a presence on major university campuses across the United States and serves clients internationally. If you have questions, call the number or visit the web address on your screen. We'll see you in January for the next Filbrandt and Company Market Update.